hello everyone. Welcome back to another episode of More Than a Mortgage, where we help people create wealth through real estate. I'm Mike Black, and this is my partner Tom Merritt joining us today, and we are thrilled to be talking about what we're talking about today because it has been a drought. I feel like I've lived in the desert. I feel like I've been eating sand for 3 years. I feel like the light at the end of the tunnel has been 100,000 miles away, and it couldn't be more of a perfect time for us to launch this episode today because we're going to really do a deep dive into when, why, how, who, what, when, where, why, and how it makes sense to refinance your mortgage, and what it what's the cost versus the savings. You will get something out of this today, and it will make sense to you when you're exploring the ideas of refinancing. So, Tom, how's your week been, Mike?
Man, I'll tell you what, it's been crazy. I feel like coming back from, fall is here, right? We got past Labor Day, and so now we're kind of school's back, summer's over, and what a better time to get ready for the end of the year with the potential opportunity to potentially refinance this.
How was the summer, by the way?
Summer was unbelievable. It went like that, which is always the case, but we had a lot of fun. Got a little family time, got a little rest, a little relaxation, but we worked hard too. So it was good.
Yeah, so very cool. With Sammy Plus, we had a great summer. Got the kids off to school, back to school, and now it's back to the grind. And I got to tell you, like, the summer ends where we're like, the family's rejuvenated and feeling great about the fall. I love the fall. It's my favorite time of the year.
Well, it's mine too.
But then it's like, I was out of town a week or two ago, and I came back and I said, what did I miss? And I love what you said. You didn't miss anything, but get ready, because I think you're going to need to put your seatbelt on, because we're going to be out for a little bit of a ride here. So
I think that's exactly what I said. I said, buckle the seatbelt. You could see the premonitions, the signs coming. I'm finally excited not to tell clients when rates come down, because they're starting to come down, and it's really evident now, I think, after 3 years that, with where we are from an inflation, and it very much mellowed out to a certain extent, with what we've seen in terms of the unemployment and just numbers not looking good, and then the job openings as well. I actually heard an article or heard on the news this morning that if you lose your job today, there's a 44% likelihood that you're going to be able to find another one within 3 months, which is down significantly from where it was just 6 months ago. So
I feel like the job markets, because I got a good buddy who's in the staffing agency, and he's always about 3 to 6 months behind us. So like when the Feds start cutting rates, I feel like the job market all of a sudden gets a little more robust. And I think that's the point behind cutting rates, is to get the economy reignited here. So for those of you that haven't been watching the news, I just, turn it on, because we always hate when you watch the news where rates are going up, because that's all they talk about. But when they're coming down, it's, we're starting to see like some 6s, in some cases 5s in front of rates right now. So it's just a good time to explore your options.
So I think it may be just a little bit of an overview in terms of how it works, right? So the federal government is out there, and they essentially set the federal funds rate. And the federal funds rate is the rate that banks lend between one another. And the government essentially controls that to kind of put fire out and or stoke the fire. As they increase interest rates, usually that kind of quells things. As they decrease interest rates, that usually kind of ignites things. And the reason why rates have been so high for so long is essentially as a result of inflation. Back in COVID, we poured all this money into the economy, and it really created an inflationary. Plus, we had the supply chain, which limited things. So we saw prices just go up and up and up. And really, I think it was last June, hit their high of almost like 9% inflation, meaning that year over year, our goods that we're buying have gone up by 9% year over year. Now we're starting to see that inflation come down, and so we're starting to see business go down, which as a result, decreasing the interest rates will help to kind of stoke the business. On the flip side, we also have unemployment, which is the other part of things come into play with regards to our economy or our GDP. And what we've seen over the course of the last 3 years is we've seen increasing employment, but now we're starting to take a pretty sharp turn downwards. We've seen revisions going back a number of months. We've seen the actual number of jobs created I mean, we were at 22,000 here a couple weeks ago, which means for our whole country, they only created 22,000 jobs. They need 200,000 just to break even.
Let's talk about that really quick, and then we'll dive into all this. But I just heard this morning, listened to the news this morning, they are announcing that they're from April of 2024 up until year to date, they are going back and revising that number down 800,000 jobs that pretty much didn't exist, right? Or that they're revising that number down 800,000. So while we thought, for the last year and a half that the job market was doing really well and there's all these hires going on, it seems not to be the case.
Now, I'll say, we had conversations, even probably on this show, about it doesn't feel like the economy is going.
That's all they've been talking about.
Right?
Yeah.
So I think this whole is coming together because we didn't feel it on the streets that things were as good as they were. All these numbers said that it was really good, but now it's kind of going back, doing that back look and seeing, and it wasn't very good.
So what does that mean? What does that mean as a consumer? I mean, I've been getting call after call after call after call this week, and what does it mean to someone who's looking to save money right now or cut interest? I mean, it's just one of those things that you hear on the news, but you're not sure if it's right for you or not today.
Yeah, I mean, if I were to sum it up in one word, I would say opportunity. And that opportunity is more to figure out what makes sense for you and your personal situation. Some people have been in their homes for 10 years and have a really low interest rate, and maybe they need to take money out. It's going to be cheaper. Some people just moved in and, kind of got in and they're a little suffocating by the payment. Other people have been in maybe for 2 or 3 years, and you know what? Maybe it's time for them to move on because now in 3 years they've outgrown their place. So I think it really depends on the personal situation, where you're at, where you're going, which again is a conversation to be had.
Yeah, that's a starting point. I mean, it's you got to sit down and you got to look at that the overall picture of whether this makes sense to you, because it doesn't make sense for everybody right now. I think it will eventually, but I will tell you, from what I've seen so far, if you have a rate north of 7% or higher, it's probably worth exploring.
At least exploring, and again, the opportunity. With that being said, and I understand it, but we said rate, and that is not the only thing to look at.
Yeah.
You and I have talked many times that everyone gets enamored with these rates. We've had multiple clients come to us and say, hey, and I just got an offer from this online lender or from push button type lender that I can give you in the fives, I can get in the low fives, and upon review, yes, the costs are so astronomical, $30,000 in some cases. They're like, well, they told me it was no cost. Well, yeah, did you look at your new loan amount? Increasing it by $30,000. So again, really understanding what it means and where your break even is and where you're, when we talk about break even.
So guys listening, that's a great point. You got to be really, and you got to know what you're looking at is, I think, where Tom's going with that. And, it's important more so than ever to have a trusted advisor that's giving you advice. I mean, there's times where I've said, hey, that's a great deal. And then there's other times where I'm like, if it were me, I wouldn't do that. And I got a client closing to, well, he might be, I don't know, he's second guessing right now. But, again, it was a situation where he got a solicit phone call, and the phone call was like, hey, we can do this for you. This was like 3 weeks ago.
Yeah.
And I said, that's fine, but you're closing right now with the company that's servicing your mortgage. You locked 3 weeks ago. And lo and behold, I'm actually lower today because I've been updating you all year on the market, and things are gotten better than 3 weeks ago. So it's one of those things we got to be really careful. Look, my rule of thumb is if someone's calling me to say, hey, I can do this for you, there's a reason they're doing that. And if it doesn't feel good or if it doesn't feel right, you might want to take a second guess and go to the person that you trust.
And again, I think this is the underlying foundation of our businesses and just in general. It's relational versus transactional. So in the relational business, We're going to go through and really see again, what are your goals? How long are you going to be in the property? What's your break even in terms of, okay, what's the cost to do it relative to how long you're going to be in the property? And those are really going to help you make the right decision with regards to whether or not it makes sense. Now, for everybody, it's different. Some people are like, if I could save $100 a month, it makes sense. Where others are, maybe I just want to save $500, otherwise it doesn't make sense. Maybe some people are like, I'm really happy with my payment, but if I can cut the term and reduce the length of my mortgage. And so again, it's not making assumptions, it's having conversations.
So let's start out and talk a little bit, like, what's the number one reason you're starting to see people refinance right now or consider refinancing? Like, what are you getting most calls on right now when it comes to this?
Well, again, I think it's the societal rate. So I saw that rates went down. What can I do? That's basically the reason for the call. And again, at that point, great. Yes, interest rates have come down. There is an opportunity. Here's where you are, but let's have a conversation about where you want to go.
Yeah. What are like some of the high points that you're talking to people on right now? Is it are you seeing more rate and term where they're trying to save money right now? Or are you seeing a situation like you mentioned earlier where they're like, hey, I need some cash out? Is it a combination of both, or where are you seeing the most opportunity right now for people?
I think the biggest opportunity for most people is still the cash flow, reducing monthly obligation. I think that over the course of the last 2 and 3 years, with rates in the mid to high sevens in some cases, people stretched to get into the places they were in, especially, because prices went up. So I think a lot of people are utilizing the opportunity to refinance to save, $200, $300 a month, just to help with the daily, monthly, yearly cash flow.
Yeah, that's great. And so you make a good point there. I mean, so one of the things that we look at and why I think it's important when we go to that trusted advisor, that person that you trust this business. Like, if you trust your realtor, you're going to go back to your realtor. If you trust your attorney, you're going to go back to your attorney. That's the best way to run real estate. I don't care, like, if you've had a bad experience, run to the mountains, right? But like, at the end of the day, there's certain things that you have to look at when you're going through this process. And one that we look at is, what's more important to you? Is it monthly cash flow savings like you just mentioned? Or is it, like, I've had so many clients say, Mike, I am so tired of seeing how little principal I pay down when I'm up in the 7% till now. Is it monthly? Is it interest over the life of your stay in the home that you're looking to cut down on? Are you looking to pay down more principal faster? So when would you look at those scenarios for someone, and give me like an example on when that's made sense recently?
Absolutely. And I think you bring up a great point. Again, when I'm talking to some of our clients, the first question is, how is the property? How is the place? How long have you been there? How long do you see? I talked to someone yesterday and they're like, we love it. It's unbelievable. We're going to be here at least 10 years plus. So that conversation is more along the lines of, okay, well, how do you feel about your monthly obligation? Are you comfortable? In this case, yes, it's fine. No problem. Have you considered a 20-year or 15-year, which in turn we can keep the same monthly obligation, but instead we are going to cut the term and save interest over the life of the loan, hundreds of thousands of dollars because of the timing and the reduction of interest rate.
I love that. He just brought up a great point. So what Tom just said is that in most cases, if you're in like a 7.5, we got clients that like in the 8s right now, right? If you're in that predicament or that scenario right now, we've seen situations right now where I just locked someone the other day that was at a 5.375 on a 15-year fix. The payment went up $150 a month, but it was saving them like $200,000 in interest over the next 10 years. So it was a huge savings, and they were like, that's a no-brainer. Am I missing something? And I'm like, the only thing you're missing is that you don't lock this today, you could be missing the opportunity to take advantage of it, right?
And in that case, and I'm assuming that their plan is to live in the property for the foreseeable future.
Correct.
They're not moving in the next 2 or 3 years.
Totally. And then I had another conversation where the client said that they see themselves moving next year. Is that worth it? I don't think so. So when is it worth it? When do you tell somebody this 1,000% makes sense for you to do? Scratch the savings part of it, but it is part of the equation. But when would you advise somebody that, hey, this is a really good setup for a refinance? This is when we pull the trigger. This is when you should consider it.
Again, everybody's situation is different, but I think at the end of the day, we're someone that's going to be in their property for at least the next 3 years plus, where you can calculate, okay, what is the cost associated versus the savings that you're going to incur? Where's your break even? And you want to make sure that you're going to be in the property longer than what that break even is.
Yeah. So just to clarify, in order to figure out your break even, I think what Tom is really going for there is like, how many months does it take you to recoup your cost? How do you figure that equation out? It's a simple math equation. You take your total true closing cost on your loan. So that's like your lender fee, title fee, appraisal.
And usually how much is it for a refinance?
How much does it cost to refinance? It's about $3,000.
At the end of the day, now there are some opportunities you could get less. There are some opportunities where it's going to be more just depending on your personal situation, but generally speaking.
So let's say you take $3,000 and say you're saving $300 a month. You take 3,000 divided by 300, that gives you a break even of 10 months.
Yeah.
Anything between a 12 to 18 month window is a fantastic time to look at refinancing, assuming you're going to be in the property. If you're not going to be in the property for more than a couple years, don't bother refinancing and spend it. Now, like what Tom just said, there are scenarios, and what you're seeing out there and hearing out there is you hear, the thing I love about our industry is that it's not transparent sometimes.
Agreed.
So when you hear that term, hey, we're covering costs, or it's a no closing cost refinance, those do exist. But let's break that down, because there's cost to doing business
Regardless.
every time. So when someone actually tells you that there's no closing costs, what they're telling you is we're giving you a higher rate to cover the closing costs, and it's called a discount. You get a discount back for taking a higher rate. So,
Or they're rolling it into their loan.
Like Tom said earlier, we've seen some online outfits that are quoting, these ridiculously low rates, and optically it looks great, but they're saying there's no cost. Well, there is cost because your loan amount, like you said earlier, went up $30,000. So guys, I think what we're trying to get, the point we're trying to get across is be very cognizant of this stuff. Now, I'll tell you something else that's like been interesting. Over the last 2 to 3 years, while we've been crawling through the desert and feeling like this is never going to come around, we've also had major inventory supplies, especially here in Chicago. So part of what that causes is a supply and demand issue. And when that happens, prices go up on homes. And we've seen that significantly here in the city. I can tell you just from personal experience on my own home.
Yeah.
And you sold a property recently, the price goes up on a home. So one of the other things you have to look at too when you're going through this is, I have a client right now we're refinancing. She put 4% down a year ago. She's got 20% equity in her place now.
Wow.
So we're saving her an additional like $130 a month in private mortgage insurance. When you have that 20% equity position, the PMI comes off your loan, and voila, that's an additional savings on top of just getting a lower interest rate too. So you gotta have that evaluation. You gotta have that consultation where you it literally has taken about 15 to 30 minutes on these calls with my clients for us to really hammer down the numbers and see what the benefit is. So that's step one, is getting that overall outlook when you're going through this and what that looks like for you, because everybody's different.
Absolutely. And so I like to say, don't get Geico'd. They talk about Geico 15 minutes or less will save you. If you're spending less than 15 minutes on figuring out whether or not the refinance is right for you, it's not enough time. The reality is somehow, some way, and I'm not saying you're getting taken advantage of, but you can't get through what needs to be gotten through in 15 minutes or less. So if that's all it's taking, take a step back, get a second opinion, because the reality is you should sit down, you should talk through what your goals are, where you want to go, and basically figure out what the best opportunity is for you based off of the current situation.
Another opportunity I want to just touch on that is kind of like no one's really talking about it a lot is credit card debt. Is at an all-time record high in our country right now.
Well, plus the percentage is what are you getting, 25% or something on that?
25%, unless you that person keeps rolling it over to zero. If you're in that situation right now where you're feeling the stranglehold of credit card debt, isn't that something people should be considering when they're looking at this? Is they maybe I can roll this. Problem that I see with it is, some people get so deep into the credit card funnel that starts dropping their credit scores.
Yeah.
And it keeps dropping their credit scores. And by the time they start really calling someone like you or I, or their lender that they trust, I feel like they're already in a situation where it's going to put them in the worse off spot for doing a consolidation to a refinance.
Well, I think two reasons because of that. Number one, because obviously it's dropped credit score as all the debt that's been accumulated. But number two, sometimes the debt to income ratio is such that you're not able to do anything because now you've overextended yourself so much. So right now it is another great opportunity to take advantage of interest rates coming down and doing some consolidating. Don't wait until it's too late.
Yeah.
These have a consultation.
If you feel that pinch at all with credit cards, talk to someone like us. Talk to whoever you trust in this business, because, you know, I think where people get psychologically stuck is they might have a 3.5% interest rate, and they're like, I ain't touching that one. I got to figure out how to get rid of these.
I'll pay 25 over here.
Yeah. So we do a really nice blended calculation for you to help you understand what your blended rate is. And a lot of times it's a lot higher than what you're paying on your mortgage. So get out in front of that kind of stuff. It's a great time to take cash out of your property if you need it. It's a great time to do renovations. As rates continue to drop and the Fed's cut rates, it's going to get better and better. So, you know, don't wait until it's too late or until you've exhausted all possibilities to pull that cash or consolidate or do the work that you've always wanted to do. Take advantage of it now, because at the end of the day, all it's going to do is improve your credit score. All it's going to do is put you in a better spot. All it's going to do is improve the value of your home. And you gotta like think about that nowadays, because as rates drop, values are going to continue to go up.
Agreed. And I think the last point of that, and what we really base everything we do, is essentially if we can improve your financial situation by reducing your cash flow or taking advantage of getting rid of high debt, then we can also look to potentially take that savings and invest it to build and create wealth through other means and the opportunities, as opposed to paying Chase or Visa or MasterCard or whatever it is. We can take that savings that you now have on a monthly basis and instead put it into some type of financial vehicle to help increase your wealth and create a return on your investment.
I love that. All right, guys. Well, we really appreciate you joining us today. I mean, it could have been better timing for this episode. And, you know, for those of you that haven't seen our previous episodes, we have some great content out there that we're putting out to help you as a homeowner build wealth, to help you as a homeowner do things the right way, to help you create the best budget out there. And so if you haven't checked out our previous episode, please do. We've got some great guest speakers that have talked on there and been on some of our, you do a fireside chat every month. We'd love to have you join us for that. For those of you who don't know who I am Michael Black. You can find me at jmichaelblack on social media, on Instagram.
Yeah, I'm Tom Merritt. Find me on Instagram at the Merritt Group. So thanks for joining us, and make sure you subscribe.
Make sure you subscribe and make sure you follow us on all. We're on YouTube, Instagram, Facebook. We'll be bummed to have you join us on our future episodes. Okay.